Good morning, my name's James Gerrish and welcome to Direct from the Desk. Today's quick recording is going to focus on NAB's result yesterday. I'm writing a report this morning that focuses on the broader banking complex and our views around that, but in this quick video I just wanted to touch on NAB's first half 20 report and the associated capital raising that was launched yesterday. I'll start with the report first of all because the headline numbers were obviously weak, but if you dig a little deeper, perhaps there could be some slightly more positive rhetoric undertone and rationale behind NAB's equity raising that they announced yesterday. So the result in headline terms was weak, there's no doubt about it. The large weakness was to do with increased provisioning. So to give you an idea, provisioning went from 470 million to 1.16 billion half on half, and that's directly related to COVID-19. 807 million of that provisioning is forward-looking, so about future deterioration across their book. They took a big software write-down that was already flagged by the market, and their trading income declined. So they trade, last half they had 700 million benefit. This half they've had 332 million benefit. The main difference is some derivative mark-to-market losses that I don't really need to go into because it's reasonably irrelevant. Given the mix of those earnings, NAB's Tier 1 capital dropped to 10.4%. So Ross McEwen, new CEO, elected to, that suggested that wasn't strong enough. So they're raising $3 billion plus 500 million in a retail share purchase plan, and that will get their Tier 1 capital up to 11.2%. The dividend is obviously in focus. They've printed 30 cents per share in the dividend. On one hand, some in the market were looking for a dividend 50-60 cents. On the other hand, our analyst was looking for zero dividend, but he wasn't looking for a capital raising either. So the fact they've paid 30 cents per share I think is important given the large component of retail investors on their register. Of course, retail investors need to support incomes in this pretty challenging time. So I think it's important that even though they're raising capital in one hand and paying a dividend in the other, which sounds pretty counterintuitive, I think it's important to understand who your shareholder base is and reward them with some sort of income for the half. Asset quality is going to be really important moving forward, and this is the key. So NAB have obviously taken a more conservative stance around asset quality, hence they've raised such a significant amount of money. I was on the conference call yesterday and there was actually some questioning and a little bit of criticism about NAB's economic forecast, suggesting that they're perhaps a little bit more positive than they should be. NAB are forecasting as their base case a V-shaped recovery in the Australian economy. They've given an 80% probability of a V-shaped recovery coming through in the Australian economy. Now, what a V-shaped recovery means? So a V-shaped recovery means a 3% contraction in GDP from FY19 to FY20, unemployment going to 11.6% and house prices falling 10% from FY19 to FY20. But all of those things bounce back in FY21. So that's NAB's base case. Another important thing around NAB and the outlook they've got going forward, business lending has actually ticked up really strongly in April. And if you think about they're forecasting a strong recovery in business loan growth from FY19 to FY20, something in the range of 13% to 16%. So that's really strong loan growth, which is understandable given that businesses are drawing down their existing lines of credit through this period. That's a natural thematic that will play out in a downturn like this. We're also seeing improved margins across that book. The cost of credit has increased given the concerns and the risks around the economic environment, so NAB's margins have gone up. So going forward, that business lending book should actually improve. They've got a bigger capital buffer moving forward. They're going to have Tier 1 capital 11.2%, which is a strong level of capital. In terms of the raise itself, they're doing it at $14.15. As I said, raising $3 billion in a fully underwritten institutional placement. We bid it into that institutional book yesterday. It was incredibly well received, so I hear. We had some large bids through our book, which implies that it was pretty well received. The $14.15 represents 8.5% discount to the dividend adjusted price as of last Friday. So it's a reasonable discount, but it's a big raise. Think about NAB going forward. Obviously, if the economy bounces back like they're expecting it to, then dividends will be able to continue to grow from that 30 cents per share half that we've seen this time round. It also is putting a lot of pressure on the other banks to A, pay a dividend, and B, to shore up their balance sheets. Westpac, for instance, has Tier 1 capital sitting at 10.5%. So if they're going to pay a dividend this time round, they're going to need to raise capital to do it. So Westpac's a clear candidate to raise capital, as is ANZ. CBA's got excess capital on their balance sheet. So some time ago we switched from NAB into CBA. We thought that their balance sheet was under a little bit of stress, particularly given their large exposure to business banking. That's proven reasonably accurate. We switched into CBA, but I've got to say there's going to be a point in time where the relative valuation of CBA over NAB will be stretched too far, and we may look to move back from CBA into NAB post this capital raising after they've been recapitalised, and to really take advantage of a recovery in the Australian economy when it does happen. So I'll be back to speak to you again soon. Hope you enjoy this morning's report. Bye for now.